Thank you for joining us for the latest episode of Financial Longevity, the Merlin Wealth Management educational podcast. In each episode, Michael Merlin, founder of Merlin Wealth Management, alongside various experts, breaks down complex financial topics to help you increase your wealth span and gain the confidence to enjoy your bigger future. For more information about Merlin Wealth Management, please visit our website at rcm.rockco.com/Merlin. You can also find Michael's book, Financial Longevity, on Amazon, Audible, or wherever books are sold. And with that, here's founder of Merlin Wealth Management, Michael Merlin.
All right, welcome everyone to another episode of Financial Longevity, the Merlin Wealth Management educational podcast. Today, we are joined by head of MWM Asset Management, David North, to discuss how the markets have fared through the first half of this year through 2025. As many of you know who are religious listeners to our podcast, we've spoken on several episodes about the headwinds facing the market this year: high valuations, persistent inflation, higher interest rates, geopolitical tensions, both caused by wars and also by looming tariffs and trade negotiations. And I guess just a general sense of uncertainty. And so, while we thought that the meaningful pullback that occurred in early April after President Trump announced his Liberation Day tariff plan seemed, relatively justified, if you will, the market has more than recovered from that downward move in just, a couple of months, and is, seemingly now reaching new highs almost on a weekly basis. So I'm going to bring David in to answer the proverbial $1 million question, which is, stocks continue to move higher in the face of all of these things that seemingly haven't really changed since, early April. And so, why is that happening?
Yeah, thanks, Michael. Yeah. Since the April 8th bottom in the stock market, the S&P is up over 25% now. And that has happened while earnings estimates has actually declined over that period. And usually earnings estimates revisions, and the stock market are directly correlated. So earnings revisions tend to go up as the stock market goes up. So this inverse correlation that we've seen recently is actually a rarity. And for a little extra context, a few months ago, estimates for the S&P earnings were expected to be 14% earnings increase for 2025, and it has lowered, but is still calling for an 11% increase. So while it's come down, it's not a huge change lower. So the market is telling us that all this tariff noise is going to end up in a subdued outcome.
Yeah.
And
so like, with that being the case, it sounds like to your point, like maybe it's a good idea for us to cover, it sounds like the market might be factoring in the best case scenario. A lot of people, I know our president hates to hear this, but a lot of people call it taco, Trump always chickens out, from the fact that these tariff announcements seem gloomy and onerous and scary, and then the deals tend to be much more constructive than that. So why don't we go through like what's the best case scenario, what's maybe the worst case scenario, and then kind of where we might think things could land in the middle.
Yeah, that's very interesting. We've had some great discussions on this, and we talk about internally how future outcomes are probabilistic, whereas past outcomes are binary. So something either happened in the past or it didn't. A drug got approved last year or it didn't. But the future is probabilistic, right? It may or may not rain tomorrow. So we always have to plan and invest based on these probabilistic outcomes. So some of these potential outcomes, there are lots of them. But the best case scenario, as you mentioned, Michael, would be inflation slows, interest rates move lower, tariffs end up lower than what was initially communicated. The U.S. is better positioned with more favorable trade or more favorable trade agreements globally, and the U.S. trade deficit improves. In this best case scenario, it's probably not far off from a 11 to 14% earnings growth for 2025, which is why we think the market is currently pricing in a scenario that's close to this best case scenario. And then even in this best case scenario, one always needs to consider the current valuation of the market, right? And that's currently at 25 times earnings and 24 times 2025 earnings. If it grows in this 11 to 14% rate, which is what we think is kind of a best case scenario.
Yeah.
So that's our kind of view on the best case scenario. And then if we flip that upside down here and say, well, what's the worst case scenario in one of these many potential scenarios? And we think this probably looks something like this. The US loses trade share globally. It's probably EU and China likely to be the biggest benefactors in that scenario. Inflation would remain stubbornly high, and as a result, interest rates would have to remain high. And this scenario would also be a negative for the US dollar. So if this worst case scenario plays out, investor behavior, which quickly shifts between risk on and risk off, would swing to risk off. And there would be a lot of downside for equities. So a drop to the level just a few months ago would be a 20% drop in the S&P. And the scary thing is that the earnings multiple after a 20% drop would still be at 20 times, which is well above the historical average, which would imply that a move lower can be significantly above even a 20% drop.
Yeah. So a couple of things with that. Number one, obviously there are several mid scenarios, I guess I would say, that it would incorporate some of the things from the best case, some of the things from the worst case, right? So could interest rate still go down? Inflation is peskily higher than the Fed's target, but not super high. And so could the Fed justify a rate cut, whether that's in July or September? Possibly. So you could get one of the best case scenario things that could also be offset by some of the worst case scenario things. The dollar does continue to weaken, based on some of the trade news that's out there. And so, I don't think we've really seen foreign money kind of run away from the US market. I don't think we've seen that yet. And I don't think we will see that. So, that if that's part of the worst case, I'm not sure that we believe that that's a high probability of occurring. One thing I would ask you though is, within these scenarios, I think that some of the optimism about earnings is probably from the projected benefits that companies should receive from a lot of the AI and automation things we've talked about, on past episodes. And so, I know we feel that those things are still yet to be seen and probably a little ways away from playing out. But do you want to just, kind of speak about that for a minute?
Yeah, absolutely. Well, we've seen a lot of spend by the AI enablers, massive data center spend, right? The eventual outcome of the AI landscape is still a big question, but I think it's pretty clear that a lot of companies are investing heavily in AI, and it's one of those things that'll likely be, if you don't keep up and spend, you will fall behind, and it'll cost you your business position significantly over time. So we think the first wave of this for an investment cycle was to find the AI benefactors that are the AI enablers. The next wave here, in our opinion, is more which companies that own significant amounts of data that'll benefit from AI will benefit. And it's not always clear from the investment community, because sometimes investors believe that a great business would be hurt by AI. So there's several scenarios here that we found these platforms of very rich data and great companies that generate a ton of free cash flow that are trading at significantly lower multiples than they have historically. and we think those are great opportunities for investing.
Absolutely. I mean, I think it's really interesting. I think we see on a daily basis, and we hear, I think, ad nauseum, who everyone believes the AI winners are going to be. Obviously Nvidia. I saw a piece of data on a slide. So again, it wasn't my data, but I saw a piece of data that showed that the market cap of Nvidia now, having gotten up to 4 trillion, actually exceeds the market cap of the entire financial services industry combined. So that's JP Morgan, Bank of America, Goldman Sachs, Morgan Stanley, all of that put together, right? So, there's no better way to be clear that the market participants feel that Nvidia is going to be the biggest beneficiary from AI. But to your point, there are a lot of amazing companies out there that, for whatever reason or another, are being classified as losers in the AI battle. And it's had incredible impacts very quietly, though, on their valuations. I think some of the companies we've looked at, are trading at historically cheap valuations, and they're companies that are such high quality that they've been in the camp where typically we say to people that you're always buying these companies at a premium because they're such good businesses that they always trade at a premium regardless of where the market multiple is or where the industry multiple is. And so to see companies like that that are trading today at historically cheap multiples because they've been seen as AI as losers in the AI battle. And to your point, David, right? That's yet to be determined at this point, right?
Yeah, absolutely.
So again, that seems to be an interesting opportunity. Not just it would seem to me that maybe kind of toward that more bullish case, right? That we've only seen so far from the stock market, the beneficiaries that are clear and obvious. But there's so many other beneficiaries that will happen, or beneficial things that will happen from AI, whether that's in the software space, like you mentioned, whether it's in healthcare, in other industries. We talk about it here every day. How we can be using AI to make ourselves more productive, and if that leads to enhanced capability to generate earnings in a business, right? Then those 11 to 14% estimates you talked about could very well be achievable, if not maybe even on the lower end, right? So again, that's something that I think we need to see play out. But with that being said, AI is only one not small, I guess one, pretty much known factor in what's been driving markets, right? And again, it's been an interesting market, and while the market continues to broaden out, which is something we have been hoping for, there's still very high valuations in a concentrated number of companies, many of which are technology or AI related. So we've done a lot within our strategies to take into account the current environment, whether it's these higher valuations for some of the large technology businesses, whether it's some of these historically cheap valuations for some great businesses that are today sort of being, the sentiment for them is not great. So maybe talk a little bit about, again, our focus being on risk-adjusted return and sort of how some of the big picture things we've been doing in the strategies over the last 6 months.
Yeah, absolutely. Yeah, like you said, everything is centered around risk-adjusted returns for us. We're consistently looking to lower volatility and improve our returns in a measured way. I've mentioned this before, but we like the little stair-step returns rather than the ones that spike and drop significantly. So we've been very active in our Inc. and ERA portfolios over the last 9 months or so. We just talk about some of those. So we exited or trimmed some larger portfolio positions where there was sizing and valuation risk. It's great that these investments had gone up a large amount for our investors, and sometimes thousands of %, but the valuation for several investments were above 2 standard deviations high, and at times we saw a negative timing catalyst, whether that's in our industry checks or something else. And so that was a trigger for us to trim these positions and lower risk. And if I were to go into an example or give you a high level example of a trade that could fall in this bucket, just to illustrate, would be, for example, Tesla. If you own Tesla and you see Trump develop a close relationship with Musk and kind of forming like a bromance, and then all of a sudden Tesla stock gets super hyped, and then there's a scenario where the valuation and the fundamentals just become disjointed completely. And you couple that with our industry checks that were showing international sales weakness as certain individuals, certain countries, certain groups of people kind of push back on Musk and Tesla. And if one owned Tesla, that would be a good example to take that as a cue to trim that position.
It's such an interesting example, David, because like you mentioned before, we've seen the market go up and earnings multiples go down, or earnings estimates go down. And you had said, that doesn't happen that often. Usually if earnings estimates are going down, the market's getting concerned about corporate earnings, about multiples, valuations come down, multiples get compressed. They're moving in opposite directions. Here is a great example of the company was moving in an opposite direction from its fundamentals, very similarly, right? The fundamentals of everything you mentioned, whether it was how many cars they're making, selling, et cetera, what their market share was looking like across the world, those things were looking very concerning, yet the stock continued to go up, right? So there was a total disconnect between fundamentals and the stock price. And I think that is indicative, whether it's in your example about the S&P or in your example, in this case, about Tesla, of the uncertainty that's out there, right? Both can't be right? The fundamentals can't be weakening and the stock go up. Something has to be wrong. Either we're wrong about either the fundamentals are, it's a blip and they're going to, turn like in a V shape, or the positive sentiment around the stock is wrong. One has to be, out of sync with reality. And like you said before, at the moment, it's still probabilistic. It's not binary, right? We don't know exactly at this point. So, I think it's something that we are keeping in mind on a daily basis as we look at our portfolio holdings is, where are we seeing this convergence? Where are we seeing, stock price move against fundamentals, or even the opposite way, where we see fundamentals improving, but the stock price is, still languishing, right? Where are we seeing situations like that? And are those opportunities to, put capital to work in something that might, eventually, the stock price will see that the fundamentals have improved?
Yeah. And I find investor behavior so interesting. Over time, technology has become a bigger part of investing and providing information to investors at their fingertips. But investor behavior and the excitement and the fear, the booms and the busts, that is always there. There's a big element of psychology in investing. And when things are going well, people think about, well, what product can this company make in 10 years, and how's the market going to look in 15 years? And then when fear picks up, they say, well, I don't care about that. I just care about how much free cash flow they have this quarter, So so going back to Tesla, when things are great, they're talking about humanoid robots and robotaxi and whatnot. But when fear grips the market, that investor time frame just shortens significantly.
Totally. So
I can give a lot of different examples, but I think at a high level, what I would just say is we've done a good job in ERA just to transform that portfolio to mitigate risk. So you really just want to not have a portfolio where there's a risk of you waking up one day and having a large position take a big loss. So having a better balance of portfolio sizing and risk-adjusted upside across the portfolio is something we've really made a lot of good progress on. And the better balance of position sizing and we closely track and monitor the position correlation within the portfolios, and that helps with the risk adjusted return significantly. And as just some evidence, even when the market was down over 10%, our ERA portfolio was still making money for the year. So we felt good about that as a true test when market fear was heightened.
Yeah. No, like I think this is the kind of environment where this kind of roll up your sleeves, difficult work is the most important, right? Because the market's churning. There's weeks where it feels, like it's moving higher. There's weeks where it feels like it's flat. There's weeks like feels like it's lower. It's a lot of it's being driven by news, as we know. You and I joked the other day that we never thought we'd have to have Truth Social, up on our screen next to Bloomberg, as we were analyzing market trends. But these days it seems like the news headlines are dominating, and in an environment like that, it's great to be able to step back and really analyze your foundation, analyze your core principles, analyze your process, analyze, the way that the discipline you're using, within your portfolio strategy, both within new idea generation, but also within portfolio management, position sizing, how we are positioning ourselves against our relative benchmarks, all of those things. So to your point, I think it's made our ERA portfolio, which has great solid long-term track record, even more solid. And we've also made some similar tweaks in Inc. In our sustainable income strategy. Correct?
Yeah, absolutely. So I used to joke with a former colleague that investing is a little bit like a dance. Like you have to always be like, this is the give and take, and you're willing to like take what the market gives you, right? So not being too tied to an investment, and being willing to give it up and make a sale when the market gives you a great price. So making these little tweaks here and there across the portfolio has yielded great results, like being willing to lower our China exposure when excitement in retrospect was at its peak, lowering defensive exposure when the sector was trading at over 2 standard deviations high, adding to consumer staples when it traded at a 20-year low in its relative valuation compared to the S&P. And then always also just looking at all of our positions and being willing to exit positions where the thesis might be broken. We're always going to make mistakes, or if there's no positive timing catalyst as we work to daily improve the portfolio. But specifically in Inc., it's the same type of risk adjusted focus as ERA that we're trying to strive for every day. But one of the key things that helped us in Inc. so far this year was the decision to add some defensive positions in this portfolio earlier this year, and that has helped a lot. And one thing to remember in Inc. That's certainly a nuance is that the underlying index, the Russell 1000 Value Index, tends to perform really well during stagflationary environments. And that's because of its composition of companies like energy and mining companies that benefit from higher commodity prices. So, part of our trades was adding oil and gas exposure as well there, just to make sure we participate in that if there is a stagflationary environment, which is still a potential outcome.
Absolutely. And so, just to summarize, from a high level, I think one thing that we have, tried to do, again, in an environment that has been, kind of difficult to forecast just based on all the moving parts, is to sit back in our strategies and sort of look at, the underpinnings and the foundational elements, the core holdings, and, get back to a scenario where, again, in an environment like this, a little tactical trading, can really help, our overall results in a meaningful way. So as David mentioned, some of these defensive positions we might have added into the Inc. portfolio, they're not long term. They're not things that we think of as fundamental buys or fundamental fundamentally good companies. In some cases, they may not even be companies; they may be commodities or something along those lines. But in the case, of an environment like this, you can kind of see a clear reason to own some of those things in the short term, just because of all the volatility and what the volatility will cause, and what it'll impact. And so I think looking at our portfolios in that way has helped. I do think we should make a brief mention of our core portfolio, which we're working on now. So we've done the work in Inc. and Era. We're now focusing on core. As many of you know, many of our clients know, core has always been our, again, our core strategy, dynamic core, our core strategy. And it's held many of the, iconic growth names that, that have driven this market probably for the last, 12 years. But, again, even in an environment like that, where, you're fortunate enough to own those kind of names, you still have to step back every so often and re-examine your portfolio positioning, as we mentioned before. Your kind of going forwards thesis, the idea that we believe that the ownership of a great company is the best way to maintain and create wealth, stands strong and tall, and it's nothing we would waver from. But things change over time. I think we mentioned on the last one of these podcasts that during the Nifty 50, GE was the largest market cap company in the world, and clearly GE is still around today, but it is certainly a very small fraction of the market cap of the largest market cap companies in the world. So had that stayed your largest growth position in your growth portfolio for 30 years, different story, right? You have to see not only what's happened, but also what's coming around corners. And so that's what we're trying to do today in core. I think one thing that we talk about a lot is clearly there's tax implications to doing a lot of that. As David mentioned earlier, these positions we've owned for a very long time, and have very large gains, and so we're being methodical and prudent and thoughtful about making portfolio decisions inside of that strategy. But we believe that making these decisions and taking some action now will better balance the returns of the portfolio going forward. And and our goal, like it has been in core for many years, is for that to be a relatively low turnover portfolio. So ultimately that's our goal. But again, in the context of better positioning the portfolio, we're making the decisions we think are required. Anything to add there, David?
I agree 100%.
Excellent. All right, so we got a few minutes left, and I know we already talked about some of the places we're seeing opportunities. So whether that's been in some of these great companies that maybe are being seen as behind the eight ball when it comes to the new catalyst driven by AI or automation. Whether it's in other companies and other industries, or the industry sectors themselves that have been, decimated. And so we're finding, high quality players within those sectors that, as the sectors start to show recovery, we can find new names within those sectors. Any other kind of opportunities that we're looking at today in any other little honey holes that you can see?
I think there are a lot of opportunities. I'll just touch on a few. So what's really interesting here is that we have a very strong fundamental investment process. And here at MWM, we've been working on trying to build out a quant overlay to help with the timing of decisions. And we've been making pretty good progress on that. So it's logically that when consumer sentiment is bad in something that's cyclical like consumer sentiment, over time it improves, gets good, gets bad, gets good, gets bad. It's cyclical, right? So the best time to invest in consumer discretionary is when everyone is down about it, when the consumer sentiment is bad.
Yeah.
Historically, the next year's returns are really positive when you invest in that time frame. But one of the things that we've noticed is understanding at what point do you make those investments and increase your position sizes? And interestingly enough, it's actually not when things are extremely bad. It's when they start showing improvement and start hitting to the normalized level. So we will hopefully soon be able to overlay that for different sectors of investing, like consumer discretionary. So that would be an area where, consumer sentiment is historically awful right now, but that would be an area. Obviously, healthcare is being picked on a lot, so there's a lot of valuation upside there. And one thing that we touched on a little bit earlier, we're talking about AI and software. Software companies are some of the companies or areas of the market that have the least exposure to tariffs. But if you have a negative free cash flow company, that's going to get hit hard as investor sentiment sours and investors' time frames shorten. So we're seeing a lot of opportunities in high quality software companies that generate a lot of free cash flow. And if the stock moves lower, those companies will increase their buyback and ultimately increase the book value share of the company. That'll drive long-term value for investors. So we see a lot of opportunities.
I think it's great. It seems like when I am just out or on the street and talking to people, everyone's sort of scratching their heads, and it's kind of a hard environment to know what to do. But I think it's kind of exciting to some extent that we have a lot of these potential new opportunities, in the background, whether that's Quant or any of the other potential high quality businesses at lower valuations. I mean, that's sort of when we kind of rub our hands together and lick our chops and feel really optimistic about the ability to outperform in the long term, because we can find some of these potential opportunities. So I did before we sign off, I did want to take 2 minutes and talk about the bond market. I know that we talk a lot on this call about the equity markets, and typically the equity markets are the right thing to be talking about. Obviously, there's a lot of dynamics going on in the bond market these days. I think most bond investors were expecting interest rates to have moderated by now, and there was a lot of purchasing on the long end of the or extension or long end of the curve, in anticipation of rates coming down. We all know that rates have not come down materially, and you still have a relatively flat yield curve. You're getting paid 4+% on the front end in a treasury backed money market, and you're getting paid 4+% on the 30 years. So a pretty flat yield curve. From our perspective and for the strategies we run, a municipal portfolio and a kind of go anywhere corporate portfolio, we've continued kind of along the same track, which is two main points. Number one, we have focused on quality. We always do. Obviously on the muni side, we're able to do that very well. And the munis have actually, given us some nice opportunities on the, from a yield perspective. So we've been very fortunate, and we continue to extend duration slightly, in our municipal strategies. Average yields are going up, which is great. Mid 4% yields on a tax-free basis are really nice, in this environment. And so, we feel really, really, really good about our municipal exposure. On the corporate side, we're always trying to find kind of the value part of the yield curve, like where we can go from a quality but yield perspective to get kind of the best of both worlds. It typically is in the crossover space, which is, a bond that's rated partially investment grade and partially slightly below investment grade, where we can find, some decent opportunities. We're still finding those. And again, as we have some short bonds mature, we are lengthening our duration a little bit, because we do think at some point the trajectory of interest rates will move lower. So again, just wanted to spend 2 minutes talking about bonds and, letting our audience know that, there are some interesting opportunities still in bonds, because, rates have not come down and there's still some solid yields out there to be had. If you're a bottom up bond buyer like we are, where we're looking at the individual names, there's a lot of interesting things to look at. So just wanted to mention that. Any last comments, David, before we sign off?
No, that's it. Thanks, Michael.
Sounds good. All right. Well, thanks again, everyone, for tuning in to another episode of Financial Longevity. We were actually going to have 2 episodes in July, so we will have another one for you in a couple of weeks. Look forward to that one, where we'll have a special guest on, Greg Fleming, CEO of Rockefeller Capital Management. So until then, we'll talk to you soon. Thanks again.
Thanks for listening to this episode of Financial Longevity, the Merlin Wealth Management Educational Podcast. To learn more about Merlin Wealth Management, visit our website at rocco.com/Merlin. This material was prepared by Rockefeller Capital Management. The views expressed of the host and guests in this episode are as of a particular point in time and are subject to change without notice. The views expressed by the speakers are solely their own and may differ from or conflict with those of other divisions in Rockefeller Capital Management. This information was provided for illustrative and educational purposes only. From time to time, we may mention specific securities or investment strategies where we have an active position on behalf of ourselves and/or our clients. Any mentions of a specific security or company is purely casual and should not be construed as an investment recommendation, investment advice, an offer of Rockefeller investment advisory or brokerage services, or a projection or illustration of the performance of any particular investment or strategy offered by Rockefeller. Investing involves risk, including the potential loss of principal. Before making any investment decisions, listeners should conduct their own research and consult with a qualified financial advisor to ensure that any investment is appropriate for their individual circumstances. Forward-looking statements, including those presented herein, are inherently uncertain, as future events may differ materially from those reflected, and past performance is not a guarantee of future performance.